What's up, guys? I'm back again. I guess this is part 2 of reviewing my lectures for today. Last time I stopped, I got to the point of how the last few bullet points here, last few questions here to ask about how fund managers, or maybe how private equity funds, are able to incentivize some of their managing directors to do the best work they can. And this kind of comes down to the question of how the fee structure is set up with a private equity firm. The most common example I used earlier was the 2 and 20 approach: 2% of capital commitments, 20% of profits. And so when we think about how, I guess, profit is shared among managing directors or directors in a private equity fund, there could be some fighting between different managing directors based on the amounts that they've received for the bonus. If it's something related to the performance of individual managers, then maybe there's going to be a lot of competition and not enough collaboration within the firm. And then if you have something that's just shared across all different managing directors, usually then the actual compensation, or maybe a manager will not perform as well because they think that, okay, I don't really need to do well, I'll just get a percentage like everyone else's. I think what most commonly happens is you have this board that really is in charge of making these tough decisions of who gets bonuses and how much. And with that, there's also a shared pool that everyone can kind of dip into at the same rate. So those are pretty much the main takeaways from the fundraising questions about different, I guess the main fundraising questions for private equity. Okay, so this is my portfolio management class. Today we talked about, so we had a quiz, and then we also, after the quiz, talked a little bit about, what did we talk about? I guess different strategies that hedge funds use, specifically focusing on how long-short strategies work. And we went through, I think, a simple example of how that happens. Okay, the first bullet point has to do with the balance sheet of a hedge fund. And a hedge fund we can think of as having assets. So these are the securities and the cash that it has. The liabilities are going to be maybe some debts that it owes. Maybe the hedge fund has levered up, or also possibly the hedge fund is shorting stocks, so there are also shares within the liability side. And I think also just equity to owners. So there's also equities to the owners, and also the capital that is owed to the limited partners. So usually these are the people that are investing into the hedge fund itself. And so when we define the leverage ratio for a hedge fund, it's really a ratio of the assets to the equity. It's just something I didn't really fully understand, because I thought leverage ratio was the actual leverage for the debt to equity. But in this case, with a hedge fund, I think the way we think about it is in terms of leverage. It's really the amount of assets that they have relative to the equity. I guess you can think of this as how much cash, or how much I guess assets. I'm not too sure how to describe this fully. Maybe you can come back to that. But risk tolerance is something that we saw today. It's a more commonly used measure, I think, used by practitioners, and it's just the inverse of risk aversion. And so you have high risk aversion means that you're more averse to risk. you have high risk, and then you flip that around, you have high risk tolerance. That means you're less sensitive to risk. There we go. The mean variance objective function. So the mean variance objective function is, I think, how most practitioners today approach the idea of portfolio optimization. And maybe with the idea of modern portfolio theory, I know Warren Buffett really hates this idea of modern portfolio theory, and also Charlie Munger too, and I really respect these two guys and their opinions. They've been pretty successful, but it seems like that this is a pretty common standard within the financial management or the asset management industry. And pretty much what it is, it's an objective function that you try to optimize. And the objective function itself, it's really just the expected return of our portfolio. And then we subtract the variance of our portfolio. But not just the variance itself, but also the variance scaled by some type of risk aversion or risk tolerance parameter. And so let's say that our risk aversion is really high. That means our variance is going to kind of blow up a little bit. And so we would really prefer less variance over high variance. That's just an example. And the way we optimize this objective function, we want to find the gradient. And so with a portfolio of many different assets, you have the different weights towards those assets. And these are really the weights that you want to optimize in order to ensure that you have the highest mean variance optimization or optimized portfolio. And so what you want to do then is find the gradient of the weight vector. The gradient of all the... Sorry, let me rephrase that. You want to find the gradient of the objective function with respect to the weight vectors, or with respect to the weights. I guess the partial derivative with respect to the weights, and that'll give you a gradient vector of weights. There we go. Okay, so let's start that from the top again, because that was a bit confusing. So the way you optimize an objective function at the end of the day is you want to find the partial derivatives with respect to the weights. And this will give you a gradient or a vector of weight derivatives, and you want to set that equal to 0. So that's commonly, I think that's a concept used in multivariable calculus, or just calculus in general, of finding maximum and minimum points on a function. You're going to want to find a point where the derivative is 0 on that function, because that represents kind of the slope or a curve, if you think about a parabola. And expressing this in matrix vector form, I forgot how to do that. I have to look back into the slides. Lagrange multipliers. Okay. I think these are used for constrained optimization. I don't know how though. Okay, and then what is the gist of quant investment? Okay, yeah, I think our professor said today that the gist of quant investment is just being able to form a problem/function, kind of like the mean variant portfolio optimization, and just having other people actually program it for you. Help fund long trades. So why do hedge funds long one stock and short another stock that are positively correlated? Okay, so I think this comes to the idea of what I thought most of class was about, this long-short strategy of hedge funds. And we talked about the case where a hedge fund might long one stock and a short another stock, and both of these returns are positively correlated. So maybe these two stocks are in the same industry, and the hedge fund is going long on one stock and shorting the other. And why do they do this? I think it's a way of hedging their bets and really optimizing the amount of returns, or maximizing the amount of return they can get. And maybe a more intuitive financial reasoning behind this. Oh, I actually think I'm about to be kicked out. So, yeah, I think I'm ready to be kicked out. So, I'll continue the stream another time. All right, see ya, guys.